Hey, Casey. Welcome, everyone, and happy Friday. Thank you for joining us for today's webinar. Before we get started, I would like to take a moment to thank our chapter sponsors. Without your continuing supports, events like this would not be possible. In addition, I would like to thank the Institute and all the leadership for Region 2 for their time and effort to assist in the creation of this webinar. And also, please stay tuned. There will be an open Q&A at the end of the presentation. And without further delay, I'm honored to introduce our Chief Economist for the CCIM Institute, Casey Conway. A little information on Casey. Casey is the Director of Research and Corporate Engagement at the Alabama Center for Real Estate, housed within the University of Alabama's Culverhouse College of Commerce. Casey is a frequent speaker for the Federal Reserve, FDIC, FHLB, state bank commissioners, academic groups, professional organizations, and industry associations. He previously served as chief economist for Colliers International US. In addition to being a frequent lecturer at international conferences, Conway has consulted with major government agencies, most notably briefing former Federal Reserve Chairman Ben Bernanke and the Board of Governors on the burgeoning subprime lending and housing crisis and its impact on the commercial real estate industry. So with that, Casey, question, are we there yet?
Are we there yet? So we had a lot of fun with this one, didn't we, Sharon, and in Region 2. Most of us remember back to the days of the paneled station wagon with the fold-up seats and everything else, and all we wanted to ask Mom and Dad was, are we there yet? So sometimes we get there and we didn't exactly know where we got to. So maybe that's the answer. We're there, but we don't know where we're at. So why don't we advance the next slide? So here's just my normal disclaimer. I'm all on my own. All your sponsors and you guys are all protected. So if I say anything crazy or insulting, I have a $100 net worth. I'll be glad to break out my my square and give you the $100 out of my account. Go on to the next slide. This one was my favorite. You know, those that know me know I'm a real car guy. And so we looked and we found actually one of the original Ford ads for Dad packing everything in and Mom already strapped in and taking a nap after getting everything together, and the kids in the back in those wonderful seats with lead paint and the tailgate and no seat belts. In the lower right corner, that is actually a picture of our family's green truckster or station wagon. The left one is probably what a lot of us had. We all had that phony paneling that would fade and then have to be peeled off. But in the middle was probably the coolest one of all. The Buick Roadmaster with the dome ceiling and the skylights. That was the coolest of all of them. So let's see where we go from here. But this is our theme. Go on the next slide. So before we get and you ask, are we there yet? It's kind of like, you know, you need to have a good navigator. So when you're forecasting things, I think a good navigator, as I've shared with many of you, and we did on the mid-year governance meetings, you know, Winston Churchill's, you know, infamous quote in terms of, you know, we really don't have the ability to forecast, and that's really God-given. He stated at a funeral in 1940, it is not given to human beings, happily for them, for otherwise life would be intolerable, to foresee or to predict to any large extent the unfolding course of events. But we're going to try to give you some clues. So I think if Winston Churchill had had the kind of intelligence in earnings reports today, maybe he'd feel a little more optimistic about forecasting. Let's go forward. All right, this is my one. We all probably have been dealing with this jobs report today, and I called it the Humpty Dumpty jobs report. Our jobs have had a great fall. Now we need to see if all the Fedsmen and CEOs can put Humpty Dumpty jobs back together. The numbers were truly staggering today. 20.5 million jobs lost, 14.7% unemployment. And if you look back in March, they were just telling us we're 870,000 unemployed. You know, the unemployment, you know, rose very substantially. The labor force participation, you know, down to 60%. That's the lowest rate since 1973. We all knew leisure and hospitality was probably going to be the worst hit, but 7.7 million jobs, or essentially 50% of the hospitality, leisure and hospitality workforce gone. Our world, professional business services, we took a big hit. Retail trade declined as well. So, you know, in the mid-year governance meetings, I mentioned that I didn't see we were going to be in a V-shaped recession. I thought we could hope for a W-shaped recession. When you get these kinds of numbers today, you really wonder if maybe we're headed towards a U-shaped recession if we really don't get this back to work. And I think that's why we're seeing such urgency to try to get states reopened, maybe over public health issues. So we'll go to the next slide. So this is the one I want you all to be paying attention to. This is the Fed's balance sheet from the 2009 financial crisis. We freaked out when it got up to 4.5 trillion. At Chairman Powell's April briefing, he's noted that we were already up to $6.6 trillion and that we would have no trouble, the Fed would have no trouble getting to $12 trillion by the beginning of next year. These are staggering numbers. But he does have the right perspective that if we don't get and attack this unemployment situation, there may be nothing to come back to, that the structural damage will be too great. So he is not going to worry about raising interest rates or causing inflation from devaluing the currency. Interest rates are going to be zero into next year. And if the Fed has to go to $20 trillion in balance sheet, it will. I just want you to put $12 trillion in perspective. That's half a year of GDP from the largest economy in the world. If we go to 20 trillion, we're almost a full year of GDP. These are unprecedented numbers that will have very long-lasting details. So as we talk about the president and Congress coming back next week, finally, and they talk about a fourth package and stimulus and how many trillions more we're going to spend, we really need to stay focused on our needs and not so much our wants. Let's go to the next slide. So this is what happens if we don't get it right. This is a paper that was written by a good friend of mine about 12 years ago, John Lifflander, titled How International Monetary Trends Affect Real Estate Values. It essentially is a chronology of fiat currencies from the Roman Empire forward and how they do collapse when you basically print money and there's nothing backing it. A fiat currency, fiat means there's nothing backing it. The last example of this was Germany after World War I. In April of 1919, the exchange between the German mark and the US dollar was 12 to 1, and a mere 4 years later, it was 4.2 trillion to 1. This is what can happen if we don't get this right and restabilize. Don't forget that inflation comes from two sources. One is asset prices and commodities, and those are deflating right now. The other is the medium of exchange. And we know from Latin American debt crises in Argentina and Brazil that if your currency becomes worthless, nobody wants to use your currency as a medium of exchange, and it basically is worthless. That's what we got to keep on the radar screen. If you really don't want to sleep sometime over the weekend, read this paper and you really won't sleep very well. We'll go on to the next slide. So this is a piece that I wrote a few weeks ago, gosh, almost over a month now, April 1st, on April Fool's Day. Had some challenges getting it published because it was called Dem Bones, and everybody thought, its roots are in the Bible and the book of Ezekiel, and Dem Bones could be considered, racist or whatnot, although it was by a very talented a couple of artists. And we all learned this in, preschool or kindergarten. And the bottom line that I was trying to draw here is, as we shut down the economy and then we restart it, we better be very cognizant of the sequencing of bones that are dislocated and the order that we have to put them back together, or the skeleton won't stand up very straight, and we might end up with our head bone connected to something near our hip bone. So you can read this piece, but that was basically something to keep in mind, is we've got to get the sequencing right now as we restart the economy. Next slide. So this is a piece that I just published, my weekly insight this week, on what's reopening and why, and try to look at how do we reconcile the fact that we don't have a vaccine, we don't have adequate PPE, we don't have adequate testing for everybody. We still have rising cases. We have more cases than anywhere in the world. We have over 3.8, 3.9 million cases. We've got over a third of it. All of our states still are having more cases. They may not be at the same trajectory, but we still are adding more. How do we reconcile that with the fact that we're opening everything up? And as you see, I got highlighted there, maybe it just has to do with we need NCAA football back this fall. But the rest of the world has decided the damage is too much and they've got to open up. So believe it or not, this week, Disney announced that in Shanghai on May 11th, they're opening up. although much more restricted. So that could be a good proxy for those of you in California. Maybe Disneyland will reopen soon, or Disney World in Florida. Germany is almost completely reopened. They're going forward. They're using things like immunity passports and more testing, but schools and shops and everything are reopening. So I point out there the AP Newswire on yesterday. They were talking about the impact of college football. And believe it or not, it's huge numbers that we're talking about here in revenue, in importance to universities and schools, and in terms of employment. 130 major college football teams across 41 states. And what we're probably looking at this fall is that we will maybe not have a regular NCAA football season where all conferences compete, because you have some with a bigger impact like you guys in the Pac-10 or the Big Ten with impacts in Ohio and Illinois. So you can see off to the right there the states that are reopening, those that are shuttered. You can see the blue, which is more the heavily impacted on the West Coast, the Northeast, Illinois. They're still not fully reopened. Next slide. So this is where I bring to point the issue and really the key points that we have to put in focus here. And those of you on Hawaii, you probably didn't know I was gonna put you on a slide here, but I did. I thought about Hawaii in your region. So as you can see, this is as of this morning. We're at almost 3.9 million cases. California has the 5th most number of any state in the country. They're still rising. And look at the numbers when you think about this. April 1st, we had less than 900,000 cases, and now we're approaching 3.9 million five weeks later. So this thing isn't going away real quickly. You can see the numbers there. We're 5 times the next highest place in the world, Spain. Our cases are not decreasing. We don't have the adequate testing. We don't know what we don't know. And when we send, say, the asymptomatic back out into the open economies, we could be reinfecting a lot of people. So without the testing, we really don't know. California, the 5th most in your reopening. Hawaii, this is what we want to see. You've had your apex, and you really are almost flatlining. This is what we want to see in all states. I put you as the best example because this probably is the best example of what we hope for across the country, but you're the exception, not the norm. Next slide. So this is why, given that bad information on the health front, why we are reopening. So this is from the Tax Foundation's great resource to look at right now. And the states are basically out of money. Their unemployment insurance trust funds are nearly depleted. And this was their latest ranking. And I thought I'd have fun here. So look at California. You're the worst. They say you only have 4 weeks of unemployment insurance money in your trust. And this again is back a month ago, the first week of April. So it would suggest maybe you're done. Look at Florida, 90 weeks. Anybody on the call want to believe that number? Florida can't figure out how to process unemployment insurance claims, yet know how to calculate what they have. Most of you that know me know that when I see something that's just totally wrong, after almost 40 years in the South, I've learned the polite way to call BS on something, and that's to say it's barbecue sauce. Florida's complete barbecue sauce. The other thing is you look at Hawaii or Arizona or your other regional Region 2 states, I want you to think of a few things. These numbers that you're seeing here were based on the numbers and the reserves 5 weeks ago. And it didn't factor in that under the CARES bill for the first time ever, that we allowed 1099 workers and sole proprietors to collect unemployment insurance. So what does that mean? Cut the number of weeks in half based on that. And if you look at it today, California, you're probably out of money. Arizona, you might be able to make it to the 4th of July. In Hawaii as well, maybe make it. So this is why you're seeing the states really have to open. This is why you're seeing Europe reopen, is that we just don't have an endless money pit. And what we're really doing is a risk analysis, balancing the public health risks with basically the economic carnage. Next slide. And so this is another piece that's related to this that I wrote in the last week here on pandemic insurance. So one of the reasons that maybe the Trump administration is railing on China and trying to get the rest of the world to investigate and do the forensics and maybe classify the COVID-19 outbreak as intentional and an act of terrorism by China is because our TRIA insurance, terrorism risk insurance, would kick in. So that may be one of the motivations there. Bottom line is pandemic insurance is not part of TRIA. What we do have that's your best hope for businesses is business interruption insurance. And if this were back in 2002 or 3, before or during the SARS outbreak, many of our businesses would have business interruption insurance covering a pandemic or virus and bacteria outbreak. But after the SARS outbreak, most insurers were smart and realized that they hadn't underwritten this risk, nor could they afford it, nor could they figure out how to quantify it. So they redid the riders in all of your policies, all of your businesses, and they eliminated it. So basically, I've not found an example where anybody has in this country in their business interruption insurance, a rider that still allows for virus or bacteria or pandemic outbreaks. Even if you did, as a property owner, you would have to have, much like property and casualty insurance, you would have to be a named insured on that tenant's policy in order for you to collect. Understand the business interruption insurance without named insured is not like the Paycheck Protection Plan that requires you to pay your rent and payroll and utilities. So the bottom line is we're skating without any insurance, but all is not lost. What we really need for businesses to open up, because the states that are reopening are finding that businesses are not so quickly opening. And one of the reasons is they're concerned about having a liability shield as they open. So that if they open, I'll give you an example, my wife, she's stayed pretty much at home, but she finally got the courage to go get a hair appointment. And she had to sign an affidavit about all kinds of things and wear a mask. But let's say that's the only place she went over the next month and she comes down with the virus. She'd be in a position to potentially sue that hair salon for contracting the virus through them. So businesses are asking for a liability shield. The president is behind it. Larry Kudlow has led the effort. You can see on the left there. And as of yesterday, Trump said, look, if we're going to do a new bill here, I think this is really important for the states and businesses. But on the other side of the political equation, they're not so wild about it. But in order for us to get these states and these businesses reopened, we're going to have to look at some sort of liability shield to insulate them from further outbreaks and the liability of being open. Next slide. So there's an interesting thing. I don't want any of us to become lawyers from this webinar, and I'm not a lawyer, but I do follow Law 360 and a lot of the cases that they do. And they had a really good piece that a friend of mine sent me from yesterday that looks at some alternatives to force majeure and ways that maybe businesses and tenants can get out of leases. And I think it's important as CCIMs that we understand these and know the terms as they might come up in our properties or with our clients. The first is called frustration of purpose. And this goes back to the Prohibition era, where let's say somebody opening a new bar right before Prohibition then finds that with Prohibition, it really can't open. And it makes a claim of under frustration of purpose that it should be allowed to get out from the lease of the bar. You're going to see this type tactic come up as tenants and businesses say, look, at the government's closed, they did national states of emergency. You can't hold me accountable for the lease and whatnot. I encourage you to be familiar with this term. Don't try to practice in it, but this is something that you can help your clients with. The other one is impracticability and impossibility. And this basically says the same thing. If it's impractical that you can operate or open, maybe you don't have an obligation to pay rent or pay on your loan. And so you're going to see impracticability and impossibility strategies employed to try to help businesses avoid. A lot of times the impossibility clause was used in hurricane or natural disaster events. So I just wanted to cue this up. This might be something new that bubbles up here and that you might want to at least know about, but please don't go become lawyers here, even though you guys did a good job with LA Law in the TV series. Next slide. And Perry Mason too. I love Perry Mason. So as I go through this deck, and this was a closing slide I think that I had with Eddie on our town hall, Eddie Blanton, our president, everything we're doing and discussing, everything that happens by market or by property type, keep this front and center. Print this out and put it on your bathroom mirror. And every morning, start with this. What happens to the value of my properties or my client's properties is going to be affected by one of two things, the change in the cap rate or the change in the NOI. In 2009, this is what I did a lot of at the New York Fed, advising the Fed during the crisis. how bad would residential subprime spill into commercial, and how far would commercial real estate values go down? In the lower right corner is the answer. Over the next 3 to 4 years, it went down over 40%. It started with over a 200 basis point spike in cap rates as liquidity dried up. There was no source of funding. The Fed was slow to respond. We didn't get policy right initially, and we didn't take rates to zero. When we got those things right, the cap rates came back down. 2 to 3 years after that event, we began to see the NOI destruction as office tenants went away, as the rents went down, vacancies went up. In this crisis, I'm in the camp that we're not going to see a cap rate spike. We might in hotels, but I think it's still going to be an NOI analysis. We've got massive liquidity, 0% interest rates, and all kinds of capital to keep the cap rates at low levels. The issue is going to be, how much NOI do I lose in my property? And how much do we reprice everything? How much do we reprice a hotel room that maybe only has 20% average daily occupancy instead of the typical 65 or 70%? What is retail? When now I can only have 2/3 the number of patrons in my restaurant than before, and I'm making less revenue, I sure can't pay the same rent. So we're going to reprice rent in every single property type. So keep this in front. My theory is that we're going to see, if we can get this settled down this year and be improving by the end of the year and first quarter next year, we might only lose about 20 to 25% in commercial real estate values. And I think even in industrial, we're going to see warehouse corrections of 10 to 15% from what I call logistics 2.0 out of this thing. But I don't think it's a 40%, but it's going to be very different. And we may see markets, this will be very bifurcated. I'm going to talk about secondary markets in a minute that lose airline route structures. They could see in that 40 to 50 or 60% decline in values in certain property types. So keep this in front of you. This is your what if thinking assignment every morning. Next slide. So this is fresh information from my friend Jim Costello at Real Capital Analytics. They just updated what's happened with CRE transaction activity in the first 110 days of the virus. I think we're now 130 days into it. And it looks at 2018, 19, and 20. And it looks at the Americas versus Europe versus Asia. And you can see the orange line in the red circles I have, the amount of real estate transaction activity in the Asia Pacific region has absolutely collapsed. It's a huge decline. They've had the virus longer. They're more anxious about onshoring and loss of jobs and manufacturing. So that may be driving it. In Europe, it's much more severe than what we've seen, but they've had it longer than us. And we also have some things with the culmination of Brexit that are factoring into that orange line number. And you can see in the Americas here, we really haven't seen a dramatic decline in commercial real estate transactions. People are still closing deals they had queued up. I'm on the board of a public REIT. We closed on every deal in the first quarter that we had queued up at the same price. We didn't retrade the deal. And so did a lot of other entities like Prologis and other real estate companies. So we need to be thinking about this and hope that that red circle I have in that big decline in Asia doesn't follow like the virus outbreak and come to us in the Americas. I'm hoping it doesn't. Next slide. So this is a very important one on the stratification of our debt. Who holds our debt by property type is very important. In 2009, the banks held over 55% of everything, and CMBS was even higher, and that's why it locked up. This time around, you can see on the left side all the different lending debt sources, and on the right side, on the top, you can see the different property types. And except for government agency, that big orange bar in that arrow, except for multifamily, the debt held by all of our property types is much more evenly dispersed. In hotel, the orange, it's only in the 15%, 10 to 15% range. In retail, the light blue, again, it's in that low to mid-teen range. So it would suggest that each of the debt sources have much more ability to absorb losses in retail and hotel. Now, if we get into real problems in office, that's a different story. We're in the 25 to almost 40% range, an average of about 1/3 to 35% of all office debt is held almost, by every single one of these entities or all their debt. So this is an encouraging slide. It also explains why the Fed and the government-sponsored enterprises, which are owned by FHFA and the government and made a lot of money off of it, why they were so quick to intervene and do loan forbearance as long as borrowers did rent forbearance. So this helps you understand who has the pieces of the debt and where it might play out. Next slide. So another one I'm watching is TREP. Many of you know TREP. They track down to the granular level of every loan and every securitization, not only in the United States, but now they do it for life companies in their new Life Comps Index, and they do it across Europe and Asia as well. And what they're showing us is that the delinquency rate is turning just 30 days into this deal on every single property type. It's turned up after getting to a bottom of almost 2.04%, the lower graph, right, to 2.3. But here's the important thing on why it's going to get worse: the yellow shaded area. So many of the borrowers that in the latest April report that they've got here, it looked like they were current. Before a loan goes in default and classified as delinquent, the loan is classified as either in a grace period or a beyond the grace period. And it's not going to be until the April data that we get in, when we see how many tenants didn't make the April payments and into May, that we see these loans that are in the quote, the grace period, actually become delinquent. These numbers and ratios are going to skyrocket. Look for lodging to be something over 10%, probably within 90 days. No one's going to be able to make their debt payments. Multifamily will probably stay relatively tame. I think it can stay under 5%. Office will take much longer to rise and go delinquent, because many office tenants that have workers working at home, if you look at their earnings, there's a new line item that they're talking about. It's called redundancy expense. They have expenses to allow you to work at home, and they're still paying for your office space, and they're still on those leases. So major corporations and banks are still paying rent when nobody's in that office space. Just like in CMBS, it took 2 or 3 years for all that sublet space to basically work through its lease, and then the tenants be able to give it up for us to really get true discovery. So really understand what's going on here and track this data. TREP does a really great job of telling you what's coming, telling you what's not understood in the data. This is really powerful information. Next slide. So this is a piece that I also did. Many of you know that one of my best sources of forward-looking information is earnings data. And the earnings data has been incredibly valuable this time around, and is going to be as we go forward. So as you know, many companies have quit giving forward guidance, and I'm actually wish we could stay there, because what they're telling us by their behavior is so much more valuable than the reforecast financial ratios that they used to give us in forward guidance. So unlike Warren Buffett, who can't find a doggone thing to be happy about or invest in this country, I'll be glad to give you a list of dozens of companies I would have no trouble investing in, and actually am. And these companies are giving us some really neat information. So on the good, Pepsi, off the charts numbers. And Pepsi wasn't afraid to reaffirm its dividend, continue to do stock buybacks, and affirm their forward guidance for the whole rest of this year. They're doing very well. Their business plan's under control because they're making more snacks and soda pops. It's really the snack business that's driving. It's a more automated process and factory, so they don't have as many workers, and they don't have the same kinds of outbreaks in their facilities as you do, say, in a meat packing plant. Pfizer, another great one. They beat top and bottom, and they've not backed away from forward guidance, and could be one of the entities with a virus or testing solution. Merck as well, but Merck backed away from their guidance. So Pfizer's got courage. You know, in the Wizard of Oz, they've got courage. Merck, they're still looking for courage. On the less good, but really valuable, was Southwest Airlines. So Southwest came in not as bad as expected. We're still only flying about 95% of the passengers that we used to. But here's what Southwest told us, as well as Delta, in their earnings. They said, look, we know we have problems. We've got cash. Southwest has several $billion in cash. But they said, look, we're not going to go through the government program that we have to fully opt into by August or September and give ownership over of the airlines and more control to the government. We're probably going to opt for bankruptcy. And they want to do that because they can discharge plane orders to a little company like Boeing that downstream affects another little company called GE. And what does that mean for a company like Airbus that isn't U.S. owned and in more financial dire straits in France and Europe? They're going to use it to renegotiate and cut gates at airports, because if you only fly 1 million passengers a year instead of 2.3 million, you don't need all those gates. So they can use bankruptcy to renegotiate all those, just like a retailer does leases in stores that it's going to keep open. And what does that mean for municipal bonds? And the other big story here is they said we're going to use it to consolidate route structures. We aren't going to fly to places that only have 10 people a day flying to. And so this is really important for all of you in your communities to be considering in Hawaii. Pay attention, because they may even discharge all of our frequent flyer points. And we all know we fly to Hawaii from the States on our free frequent flyer points. But if they discharge those in bankruptcy as well, what the change in route structure means is that there's going to be winners and losers, and there are going to be secondary cities that don't win, that don't end up with route structures. And if you don't have route structures in business travel, your convention centers, your viability for site selection and business activity and retail openings and hotel businesses really takes a hit. So if, for example, you're in Nevada and you're Las Vegas, you better be paying attention to route structures and what Southwest is telling you in earnings. If you're in California, in your major markets, you're probably okay. But as you get into your secondary markets throughout California or in Southern California, a John Wayne Airport, do the airlines still fly to that airport versus mainly only the main airports in Southern California? I'll give you some that I think are going to be very, very likely to be hurt. A St. Louis, Missouri, a Kansas City, which is building a new airport right now. There wasn't a lot of flight demand then. It was more manufacturing. It was more logistics. And now as these airlines look at service, they're going to cut routes. So guess who's already getting permission to cut routes? Frontier, JetBlue, Alaska Air, they're already doing it. This may be one of the most important things for all of you to have on your radar screen. For us as the CCIM Institute with the National Association of Realtors and our other industry partners to really be on top of and watch, because this will have as much of an impact as anything on the value, the occupancy and demand for our commercial real estate as anything. If you're a major city or you're a secondary city and you lose air route structure, you lose a lot. Your convention center, all the things that you've been building over the last decade really become into risk. And if you also look to the right there, I'll give you some connections here that also factor in. Look at what happens with banks and financial services. And they're already finding that they don't need the space. Big banks, Truist Bank, the merger of SunTrust and BB&T just announced a new 500,000 square foot lease, and they bought the building in Charlotte, North Carolina. They're already starting to look at redundancy cost and saying, wow, that was a really badly timed deal. We may only need 100,000 square feet for our headquarters because everybody can work at home now. What does that mean for Wells Fargo and Bank of America? What does it mean for your financial services and your fintech companies? I also think this has very important implications for suburban versus urban demand on all property types, whether it's multifamily or office. And we're already seeing reported in the earnings by home building companies like D.R. Horton that the people that they're seeing buy homes now and come out and look at new homes are millennials that lived in the urban areas that were already stressed with the price of $3, $4, $5 a square foot rents, and they're psychologically scarred from densities. So I'm betting on the suburbs coming out of this thing over the urban areas. And you see the TSA checkpoint thing I've got there at the bottom with their link. The good news on the TSA thing is, as we open states, the numbers grew from less than 100,000 to almost 200,000 last weekend. That's a start. But it's still 200,000 is a long ways away from 2 million plus passengers. Next slide. So let's talk a little bit about property types. This is multifamily. I love this piece by the National Apartment Association that showed where $1 of rent goes. And what we have to think as owners of these properties is what happens to that dollar post-COVID. Well, if we have loan forbearance, because we gave rent forbearance and we don't collect all that rent, and we have accrued interest and the loan amount goes up, I'm actually going to have to pay the banker more than what I used to, or the GSE more than I did that holds my debt. So who's the last person to get paid in the multifamily rent dollar? It's the property owner. And if we have higher expenses from higher janitorial and sanitization, more CapEx to do touchless hardware, HEPA filters in the HVAC systems, and more loan to value and interest and debt service payments, then there's less to go to the end property owner. And so if cap rates stay the same in a very low range, I lose NOI, the value of my multifamily is less. On the right side, what I want to show you is where I think the differentiation is going to be on multifamily, because everybody seems to be in the camp there's no hit. Distinguish workforce multifamily from student housing. Workforce, I think, will come through this fairly well. Student housing, all the housing on our university campuses. I just showed you got over 130 of them that are across 41 states that are doing college athletics at a pretty high level. Those students have all been sent home. Most of those leases have act of God or act of university clauses in them, whereby stemming from events like the Virginia Tech shooting, if you have the university shut down for 30 or more days, the student population has a right to opt out of their lease. For both my daughters that had to return from college and graduate and undergraduate school, we found just such a clause, and we were able to get out of their leases in March and not owe rent until their August renewal. That's a big deal, and the student housing sector is going to take a significant hit here. The skill set of CCIMs to help with the private student housing sector is going to be massive. How do you restructure it? How do you rework it? What do you do if more students don't come back to campus, if enrollments are down 20 or 30%, because the trend towards online and remote learning just got accelerated like online grocery by 5 years. The other one is, I think, urban versus suburban. Urban, we were already seeing affordability problems, the rent's too high. And now you add the anxiety over being in density areas and mixed use projects that maybe as a hotel project that's empty or you don't know who's coming and going. That population set is already telling the home builders they want out of the city. So they go to the suburbs, they can work remote. And one of the compromises, I think, for our workforce is going to be, we are going to reappreciate our office space, and that we need one at least 2 or 3 days a week, because being at home 100% of the time is just chaotic, even if the kids go back to school. But we're not going to want to give up the ability to be close to home and engage more frequently. So we're going to want an office that's closer to us, which is the suburbs. And we're sure not going to engage in public transportation like we did in some of the dense cities. So places like New York, Philadelphia, Washington, D.C., San Francisco, even LA, there's going to be I think a recoil away from dense cities with public transportation and back to the suburbs. Anyway, D.R. Horton gave us some good earnings there. Equifax was the one that warned about redundancy costs, this thing where maybe companies have to continue to pay on their big offices in the city, but they create something different in the suburbs for remote work or part-time remote work. Next slide. So this one is where the other thing I think is going to be interesting on office, to bring office into focus, is what they had been calling hot desking, high density, all the tech workforce. It's done. It's not going to be anything like what it was. It may not completely go away, but we're going to reverse the density ratio in office from the 1 to 150 ratio that it fell to from 1 to 300, say 10 years ago, to something back above 1 to 200. We're going to get rid of 25 to 30% of the cubicles. We're going to have more distancing, and we're going to use technology to give confidence to workers that do come in, or clients that do come into our office spaces, the ability to know things like there might be sensor tracking tied to our phones that has screens around that tells us where there's congregations occurring, when the lobbies are packed from morning rush hour, evening rush hour, or lunchtime. We're going to give up a lot of privacy, but we're going to be able to monitor things to make us feel psychologically okay. Cleanliness, we're going to use this. It's going to be part of our janitorial services, and to tell us when spaces have been cleaned and when they haven't been cleaned, and which property managers are doing a good job. IRM is all over this type stuff. Touch points. We're going to get more touchless in our offices. We're going to spend CapEx to maybe put our phone up to unlock a door, or to or audio for elevators instead of touching elevators. We're also going to use this to do contact tracing. So if someone gets the virus, or they travel to a hot spot and they come back, we're going to know exactly where they went. It's going to be tracked on your phone like you've never seen before, just like your spouse's divorce attorney has your phone tracking everything and every move and every expenditure you did. This is going to facilitate that. So the whole world in office and technology is going to be a big part of that. There's this really cool company called Symbiosi that already has all this technology that they're deploying in parts of Europe and London. Next slide. So this is retail. I think we had this graphic from Visual Capitalists on the mid-year governance meeting with Eddie Blanton, the town hall that he and I did. I want y'all to go back and read the retail evolution paper that the CCIM Institute published back last October. All you need to do to update it is take any of the dates that we had in that paper that called for something by 2025 and advance them 3 to 5 years, and the paper's still valid. Everything we talked about in terms of the trend towards online grocery, online auto purchasing, end of auto dealerships, all of that has been accelerated by 3 to 5 years here because of the pandemic. The other one in Visual Capitalist here, the reason I think this is such a powerful tool, and if any of you don't look at it or subscribe to it, it's pretty cheaper. There's ways to get it for free. This was a graphic they put up on what we're spending money on and what we're not. So on what we're not buying luggage, briefcases, swimwear. We're not getting married. We can't go to the beach. We can't go out anywhere. But look at what we are buying. I think we'll buy less gloves, but look what we're buying. Bread machines. We're doing more stuff at home. We're discovering kind of a new activity. Look towards the middle though. Weights and fitness goods. In the Weight Watcher earnings, this is a huge bellwether cue to monitor from Weight Watchers. Going into the first quarter, Weight Watchers had 75% of its subscribers that did face-to-face activity on counseling or weight management or whatever. In just the last 60 days, they flipped that ratio from 75% face-to-face to 75% virtual. And guess what they found out? Their subscribers went up. They like it more. Weight Watchers can get more data on you. They can push more marketing and stuff out to you and track what you're buying. And I think this is a proxy for what's going to happen to gyms in our retail centers. My wife now does Zumba. We have taken one of the kids' bedrooms and we bought additional fitness equipment, and neither one of us are really wild about going back to a gym. We can be at home. We don't have to, worry about public lockers to change and shower and all that type stuff. And I think Weight Watchers is a used proxy. The other one is look at the Shopify earnings. Shopify is crushing it, and they're crushing it because of bad Amazon behavior. Amazon did a terrible job stocking its Whole Foods grocery store chain compared to, say, a Publix or a Kroger or a King Soopers or Safeway. They pushed all their emphasis onto the most in-demand goods running through their warehouses. And they said, if you're a small business and we don't think you have essential products, we're not going to restock our warehouses and we're not going to facilitate shipping stuff. So small business got screwed by basically Amazon in this process. And who was sitting in the shadows? It's been working with these smaller businesses and tenants, little old Shopify, and they are just crushing it. And look at their numbers. Their e-commerce market share has grown almost 6% and exceeds that of eBay, Walmart, and Apple in one quarter. And so FedEx is on top of this, Shopify is on this, and this is a retaliation or reaction to bad Amazon behavior that they're not going to go back to. The other bad behavior that Amazon was known for that small businesses particularly worried about, I'll use my red Allbird shoes as an example. Allbirds would not sell those shoes, good California company, would not sell their shoes on Amazon. So Amazon retaliated by creating a knockoff brand and reducing the price 50% to put Allbirds out of business. This is what's driving some of this stuff that you're going to see how this all changes. So this is some of the stuff you can look at in retail. This is why I read these earnings, and they're so important to help you know what the future is that Winston Churchill couldn't see. Next slide. So logistics is going to be the other one. It's very important for you in California and the West Coast. You have very vital ports. LA Long Beach was the busiest container port. And before the outbreak, even in January and February, Port Laredo on the right there surpassed LA in the most container traffic. And this wasn't accidental. This has been building for a long time. And what it means is we had a good trade agreement between Mexico, Canada, and the US, North America. We're going to see more trade and more manufacturing reshore in North America, not just the United States. That's going to mean we're going to have more north-south trade. So that means that places like Arizona, that places like that touch base with Kansas City Southern Rail, and they get up into the Midwest, or they bring stuff down from Port Rupert instead of, say, Seattle and Tacoma or Oakland ports, that they're going to be more north-south rather than west-east trade. A little year and a half ago, in January last year, the university, we published this logistics infrastructure paper. It's one of my most thorough pieces that I've done in my career. We connected all the dots on logistic infrastructure, not just ports, but rail, but trucking, but e-commerce, and where and why it goes. And the gist of that paper was what we were seeing over a year, 2 years ago, was the evolution of our economy from a shop and take home economy to an order online and deliver. And COVID has just advanced that by many years. And it's going to mean very structural changes in our logistics infrastructure. So if we go to the next slide, we'll see how. So I just got the numbers today, the new North American Real-Time Indicators report from the American Association of Railroads. And the last one that I didn't have this morning showed that it was the worst numbers, the worst total rail car and the worst total intermodal numbers since they began collecting data in 1988. Guess what it was for April? It broke that record. And the worst things are moving anything energy, moving autos, and moving chemicals. They're just dead in the water right now with manufacturing closed, Boeing not making planes, the 737 not being manufactured. So the numbers are terrible. We know that can change when the ports reopen and we see goods and containers come in. But I want you to be aware of a term at the bottom there that we haven't been exposed to for a while. It's called demand shock. And this is after a recession or immediate shock to the economy. Businesses are lost, retailers are lost, and companies that have cut CapEx and CapEx projects, they now don't need to take orders. They cancel orders, and things that are coming in through the supply chain now back up, and they have to be warehoused. This demand shock is going to be a big interim driver for warehouse space. In long term, what's going to further increase it is what Prologis, in a company that I'm on the board of directors for, told yesterday in their earnings call, is something called supply stock. We're going to do away with just-in-time inventory from the Japanese in the 1980s, and every sector of our economy is going to have additional supply stock on hand so that we can weather at least 90 days to 6 months any other kind of future disruption. So this is really powerful information that comes out of this data rather than just that the numbers were horrible. Next slide. We're almost there. These are some other freight metric measures. I've talked about the TSA passenger count. The TSA passenger count may be the most important forward-looking index we can have as to the health of our economy, the health of our region, and the health of our state and airports. And TSA breaks this down by state and by airport. And so you can look at these numbers, and if we don't see these numbers get back by mid to late summer into the 1 million to 1.5 million passenger range, we are in serious trouble in terms of hotels, conventions, arts and entertainment, any kind of venue. We really have got to see this change. So I'd be looking at this every day. The Cass Freight Index, what you want to look at is the balance between inventories and sales. You can see how it spiked in 2009. We're not there yet because we've had shortages of everything, but we're going to see the consumer readjust type things here. The other is the trucking tonnage index. We should see that spiking, but again, because there's no goods coming in at the ports, they're not being put on rail, they're not getting delivered to the distribution warehouses. So these are 3 or 4 great forward-looking ones that, as go these indices and transportation and freight measures, will go our economy, and they'll tell us how we're doing and getting going again. And they're a great proxy for them what follows in commercial real estate demand. Next slide. So I'll wrap up. These are my top points. I shared some of these, I think, at the mid-year meeting. I'm hoping that we only see a W-shaped recession, although after numbers that we're seeing the last few weeks here and the jobs numbers today, I'm becoming more concerned we could see a U-shaped recession, especially if Congress and the president can't get their acts together and do greatest generation behavior and figure out how to get things done. The Fed cannot continue to call Treasury and say, print trillions while Congress can't get its act together. Just like we created CMBS 2.0 after the financial crisis to fix what was broken in liquidity and permanent debt and securitization, we're going to have logistics 2.0. What's it going to look like? It's going to be more north-south logistics activity and warehousing from Mexico up through the center part of the country, from really benefiting Arizona, Kansas City Southern Rail into the Mexico ports, in the center part of the country and the Southeast. It's also going to mean that we're probably not going to continue to build these mega million-square-foot warehouses, because if you have an outbreak in those, you really mess up supply chain. So if you want to see what the box is going to look like in the future, walk down the cereal aisle in your grocery store sometime in the next week or so and look at the variations in sizes of cereal boxes. We're going to see many variations and many redundancies in supply stock. Additional supply stock will not be stored with regular stocks. It's going to be very different. Retail evolution, it's just all been accelerated. We were on this trajectory. All this stuff that was happening in online grocery and online autos, it's just been moved forward 5 years by the virus. I reinforced the paper that CCIM Institute that we wrote 2 years ago called Adaptive Reuse. This will be CCIM's most important skill to fine tune over the next year. This is where you can be the most value to your clients, whether they're hotel, whether they're retail, whether they're in a secondary market that has route structure damage. And what do you do with office and multifamily? What do you do even if you're in one of the emerging cities that does well, like an Atlanta or a Phoenix or in LA, in parts of the Central Valley that are important. What if those reverse from the inner city back to the suburbs? What do you do with the dense parking lots and the public transit systems and the extra freeway lanes? What we are going through is going to be much tougher and longer than we can imagine. And today's job report reinforces it. Before I got on this webinar, I contributed a piece to our ACRE website. We do a COVID-19 piece, and it's called the Humpty Dumpty Jobs Report. And really, can we ever get all the Fedsmen and the CEOs to put all of the jobs pieces back together? It's going to take time, and there's going to be industries that are structurally damaged for a long, long, long time. This isn't going to be an easy stand-up and we're all okay by the fall. So what I would tell you is how we get out of this, how we change the psychology and everybody's fear. We are going to end up with immunity passports. They're already using them in Europe. And what would that look like in the US, and how long would it take? Imagine after 9/11, could any of us imagine TSA pre-check and a clear system and taking our shoes off? The answer is no. As good as I am at looking forward, I couldn't have forecast that. The clear system was developed as a medical technology tool. They already have the ability to vacuum up and put in place everyone's medical records today. If they can get the HIPAA laws changed and they can match that with our ability to move around and have an app on our phone that says, if you don't have a current flu shot, if you don't have an updated reading on your antibodies from the pandemic and COVID, you can't fly today. You can't go to the inner city. You can't go to an office building. You can't get on public transit. You can't go to a football game. You can't go to a concert. We will have, within 1 to 2 years, an app on our phone that has our immunity passport with all of our medical records, all of our vaccinations, whether we're current or not on the flu shot. And you'll have another piece. I'm a diabetic, so I have to finger stick every day several times and check my blood. And now I've got a thing in my arm that I can check it with my phone, and I upload that to my doctor, and I know what my blood sugars are. We're going to have a home test that we're going to buy, and these will just be like buying toothbrushes or our water pick systems. And we'll take a swab in our mouth, we'll put it in a little testing kit. It'll give us a reading on our antibodies and our health, and if it's good, we'll upload that reading to our app, say our ClearSpan app, and it will allow us to basically say we can go out in the public, we have our app, and we can say we're virus-free, and we can go. It'll also give us the ability to do contact tracing, so no more of these viruses do we have to worry about China not telling us the truth or us knowing where it's been spread. It also means that in our office buildings and all of our commercial space, we're going to have much more technology that does occupancy monitoring. And we're not going to go to restaurants. We're not going to go to venues. We're not going to go to dense places unless we know that there's occupancy monitoring as well as immunity passports. So let's see, I think we got one more slide and we'll take some questions. So you asked at the beginning, Sharon, have we arrived at the end? Good news. We're at the end of my cheery news. I'm a car guy. I love the old vintage VW buses. Those of you that follow Nike know that Nike started, its original supply chain was a VW, 1967 VW bus that the founders would travel to track meets and sell their tennis shoes. I think we have arrived in isolation. I think we've arrived scarred and damaged. I think we will go back and we'll let somebody park their bus next to us. We will function more in the suburbs before we'll function in the cities. It's going to change tremendously. The skill set of the CCIMs is never more important. Your marketing skills, your financial management skills to model and figure out what forbearance means and how do I restructure leases, the marketing skills as to what do I do with a property that maybe its use is changing or I need to reprice because of its density. As Eddie Blanton reminded us over the last week or two, CCIMs are open for business. We may have to adaptively repurpose our own skill sets. We may do less broker transactions, but that doesn't mean we don't do other types of transactions or revenue generating activities, be them consulting or otherwise. So hopefully this helped stir a little thoughts, and we're open. I'm done.
Casey, that was just a mind blow. I'm going to give you a little break here, and we have our second poll coming on. So can we roll that, please? And there we are. What's the first thing you're going to do when retail doors reopen? You know?
Good question.
Yeah. 5, 4, 3, 2, 1. Okay, what's our
I think we're all going to get a haircut.
Okay, what do we have here?
Hey,
Get a haircut. You're right. You're right on again.
it's the magic red shoes. I'm wearing them just for you today.
Oh, we've got a question about the red shoes, so that'll be coming later. Okay, we'll close this out. So Region 2 was kind enough to submit questions before our presentation here, and so we're going to start with that, Casey. Here's the first one for you. Is the Fed intervention a kind of push me, pull you, or a Dr. Dolittle quagmire?
It definitely is a push me, pull you, and I guess I just dated myself, so I must be 58 or in my late 50s to know what the heck that is. That's the original Dr. Dolittle, not the remake. You got to watch the original one. So what the Fed is trying to do is they're trying to inject the push me. Their push me is all of the liquidity into the system. They took rates quickly to zero. They've had massive policy intervention. They start the Main Street Fund. You know, initially I was not pleased with the Fed when their first two reactions were to just lower rates. I'm like, oh my God, we're repeating the same thing from 2009. We'll never get to the right policy intervention. So that the push me, they learned from that. Powell's doing the right thing and pushing the liquidity in. Think of this, what the Fed has already injected. Am I still with you?
Yes, you are.
Okay, my screen said it's launching, so I didn't know if I lost you. So what the Fed is doing is they've injected almost $3 trillion of cash in the system. That is almost an entire quarter of GDP, if you think about that, or half of a quarter's worth of GDP. They've said they're going to 12 trillion. They're going to go to 20 trillion. What the Fed is also doing through policy intervention is the Fed is also trying to pull us. They're pull you at the same time they're pushing us. They're pulling, and what they're trying to do is they're trying to pull workers back to work. They're trying to pull businesses back to being reopened. So it is absolutely a push me, pull you. If we could get Congress in a push me, pull you, helping do the same stuff, I think we'd be a lot further down the road more quickly. But I do have to tip my head to the Fed. I just worry if we can come out of this without a collapsed fiat currency 3 years down the road. I don't know what our dollar is going to be worth.
Okay, you ready for another one?
I'm ready.
Okay, do you see any regional advantages at play in economic recovery?
Absolutely. So one of them I gave you was pay attention to the airline route restructures. If you're in a city that ends up on the short end of that, your commercial real estate in your economy is going to take a hit. If you're a Kansas City with a bond issuance with a brand new airport and nobody opens up there, you might look like what Denver did when Denver built its new airport from the old Stapleton. I was there. I managed all the assets for Equitable Real Estate, and Delta said, we're not going to pay these new outrageous landing fees, and we don't think your automated baggage claim is going to work. We're packing up and we're going to Salt Lake City. And so Denver was in a world of hurt. They had to cut a special deal with United. It was very disruptive, and it almost put Denver back on the teetering of not coming back out of the oil patch and the S&L crisis days. So there will be differences. I think this is going to be harder on the secondary markets and tertiary markets because you're not going to get the same infrastructure. On the other hand, though, if your secondary market's in proximity to a major market that has amenities, so let's look at San Francisco. A lot of great communities as you go into Northern California that are close to San Francisco that are secondary that you could drive into, heck, even bicycle. You bicycle a lot out there in California. That you might find that the remote work is great, quality of life is better, I don't need the office, I'm still not too far from a major airport that I can travel. So I think we're really going to have to watch the route restructures. I think that's going to be the game changer for the cities, is whether you end up with route structure carnage or whether you retain it. And the two I'd be paying attention to are Southwest and Delta. Southwest, they own half their airplanes outright, they have $7 billion in cash, and they think that the places they're going to fly to, you're going to have a reason to go there, a business reason, a tourism reason, an entertainment reason. So be doing the homework. Why in the world would I go to Kansas City or St. Louis, say, when I don't know what my business or tourism destination is compared to, say, if I'm in California, Hawaii, or Arizona? There's a lot of business, there's a lot of tourism, there's a lot of reasons to go there. That I think it means why Southwest will fly to many markets in California and to Arizona and parts of the Southeast.
Thank you, Casey. Next question. What is the reality of the office sector taking a hit as we all come out of this?
So it's going to be slow. So I mentioned the biggest thing, we're going to be fooled by office. We're not going to see vacancy rates skyrocket because major tenants have long-term leases. I was on a call on this morning with a major investment fund that has thousands of building assets all across the country. And they're already seeing that their tenants are telling them that their employees are telling them, we're not coming back to work downtown. We're not going to do public transit. We're giving up our apartment leases. We will work remote. You know it works. Deal with it. So those leases will stay in place. It'll take years to burn off. They'll try to be sublet on them. And companies are already telling us the earnings that they're going to have redundancy costs. They're going to have to lease some level of suburban space to help the workforce that won't come downtown anymore, to have meeting space for 1 or 2 days a week or team meetings or client meetings. So they're going to have that redundancy cost. So I think it's going to be slow to see the delinquency. Tenants will pay. We're not going to see the same spike in defaults and delinquencies and credit problems in office as we are hotel and retail. And just like the financial crisis, office came 2 or 3 years later. It's going to be 2, 3, 5 years later when we see these office leases burn off in downtown markets and those tenants not renew, and we see more demand in the suburb office space.
Thank you. Okay, here we go. How will COVID-19 affect industrial? Will states, cities, counties now want more warehouse space to stockpile supplies so they're not dependent on our current logistics structure?
So absolutely. I said we're going to have logistics 2.0. So remember where you all heard it first. CCIM's heard logistics 2.0 first from the registered economist. and what we're going to see is just like after the financial crisis, it is going to change. I think the logistics movement of goods is going to be more north-south than west-east. We are going to retaliate against China. We're going to move more of our vital manufacturing, whether it's pharmaceuticals or PP&E and not just manufacturing. We're going to move it back, not necessarily to the United States, but maybe to our neighbors, particularly Mexico. Mexico can get things done with the EPA, where they don't have an EPA like we do, so they can do a lot of things in manufacturing that might take us years to do. So that means that Kansas City Southern Railroad is going to be very valuable. That north-south trade is going to become more important. It doesn't mean that the ports of LA Long Beach are going to become useless or not needed. It just means they're going to be servicing more of the 40 million population out of Southern California region versus supplying the entire rest of the country. I think it also means that the box is changing. So if we're going to need to have more supply stock, or we're going to initially have to store demand stock that is canceled orders, we're not going to commingle it with the throughput. So we're going to look, where do we put that? And it may be in different places that don't have to be just-in-time inventory or last-mile delivery. They could be a day away. They could be a half day away. They could be in secondary markets. And like I said, if you want to see what the box is going to look like, look at the cereal aisle. We're going to see much more variation in the size of the box. We're going to see the supply chain continue to evolve to adaptively reuse retail as warehouse. So we saw Amazon do this with the Toys R Us stores. The public REIT I'm with, we bought a failed mall in outside Dallas, Texas, Mesquite, Texas, and converted it to an entire FedEx distribution and return center that was 800,000 or 900,000 square feet. So it's going to change in the flow where it goes. The emphasis in ports, places like Port Laredo become as or more important than LA. The Gulf Coast ports become very important. A Mobile, Alabama that today only handles less than 500,000 containers could be nipping at the heels of the ports of Georgia and South Carolina within 3 years, as Walmart has just completed its massive redundant supply chain to supply all the Gulf Coast and mid-South states. So we're going to see that change incredibly. My two biggest port bets that I had in my logistics infrastructure paper before, almost a year and a half ago, were Port Freeport and Port of Mobile. It's absolutely amazing what's happening in the deep water ports. They've got more Class 1 rail services, better rail connectivity. On the East Coast, I think South Carolina and Georgia are going to stay very strong. In Florida, the new inland empire for Florida is in between Orlando and Tampa, in places like Winter Haven on the I-4 corridor between Orlando and Tampa, where they basically aggregate in that location, just like the Inland Empire does for the ports of LA and Long Beach. So it's going to change a lot, and the costs are going to change a lot as they have to do more sanitization and have stops in between. These warehouses aren't going to be able to run 3 shifts or 24/7. They're going to have to be sanitized. People are going to want to know that their boxes are virus-free during flu season. And I think what it means is more automation of the warehouse and more job loss that we were already seeing.
Thank you, Casey. And here's our last question we have time for from Region 2, and then that is, where are the opportunities and the likely damage/risk?
Where are the opportunities, and what was the second part?
And the likely damage/risk.
Okay, so I think the opportunities are definitely in industrial and in housing. I think the opportunities are in the suburbs more than the cities. The suburbs are going to be a huge beneficiary when we're going to see the repricing in the suburbs. The demand could shift. The home prices could rise more in the suburbs than they were rising in the cities. The demand for office space that had been kind of lackluster could get very strong, I think, in the suburbs as companies look to basically have a redundant office facility for their remote workers that don't want to come back to the city and deal with public transportation. So I think suburbs over cities is one big opportunity. And obviously, I think the high-dense inner cities, New York, Chicago, Philadelphia, hate to say it, San Francisco, maybe LA, although LA, you're all in your cars, so you're already kind of social distancing. The traffic jams are going to just get worse because you gotta be 6 feet apart from the traffic in front of you. You don't have a lot of these in the West, like look at a Colorado, look at a Nevada, look at an Arizona. You don't have the same type of density structures and public infrastructure that you do in the Northeast or say Northern California. I think workforce multifamily is a good opportunity. The risk is the student housing component. On retail, I think restaurants, and experiential retail. All the rage was experiential, where we all get together and we do rock climbing and we do gyms and we do all this interactive axe throwing and all that type stuff. I think that takes a real hit. And we go back to lower density or more consumer staples type retail, or retail that becomes telemedicine, branch banks, out parcels, end caps in retail centers become places where we drop off tests, where we renew our immunity passport, where we do all kinds. We've learned we can do telemedicine now very well through this crisis. And I think that's a perfect fit, a perfect adaptive reuse into retail as we go forward. So it's not all gloom and doom. And like I said, the most important skill set that touches all of those is your adaptive reuse skill set. And I think we're going to see local governments that fought adaptive reuse, that were afraid to do an adaptive reuse because it might get their elected official fired because someone opposed it. We're going to see local governments adapt and adopt flexible adaptive reuse ordinances like we've never seen before. Go back and read that adaptive reuse paper. Plagiarize the adaptive reuse zoning ordinance from Tucson, Arizona. Take it to your local community. Meet with your governors. Meet with your local chambers of commerce. Adaptive reuse is a key accelerator to getting our economies and our empty real estate that's going to result back on track.
I completely agree. The real estate will always be there, but the use might change. So
Right.
we've got a treasure trove of questions coming in. So, and while I'm getting that organized for you, you and I had a conversation about tenants paying with credit cards.
Yeah.
You want to reach out with that a little bit?
Yeah, so I had a couple of major multifamily investors that own tens of thousands of units across about maybe 18 states raised the issue to me that they were a little concerned about how many of their tenants in April paid their rent with credit cards. And they didn't understand that because they were offered rent forbearance, but they don't think they understood it. And they don't think they understood the tentacles. So in my conversations with Freddie and Fannie and the GSEs, they were totally caught off guard by this. And they haven't put enough clear guidance out there to property owners and borrowers, since 93% of the multifamily debt is to them, is to the GSEs, that how they expect rent forbearance to be managed. So the first thing that's probably going to come out of the GSEs is that if you provide rent forbearance, and you work out a plan with the tenant, say renew their lease for 12 months and maybe make a payment plan, that they are likely to give you interest rate forbearance on that pro rata amount of the loan or the revenue that supports your loan. So that is a benefit that is likely to come out shortly to be communicated to the borrowers and owners of properties. The second thing is they're going to give guidance about how tenants are supposed to repay. They do not want to see landlords and property owners telling tenants that after the states reopen, you immediately owe all of your forbeared rent. And so what they're looking at is they're encouraging a situation where the landlords and property owners engage with tenants and say, why don't we renew? You had 3 months left on your lease. Let's do a renewal of 12 months. We'll lock you down for 15 months. What you owe would work out to $50, $80, or $100 a month more in rent. We'll do it at no interest rate, and we'll have a payment plan, and we won't report anything to the credit agency. So there's no credit agency hit, there's no interest on it, and it's an easy to manage payment plan versus all due at once. The tenants are thinking all is going to come due in 30, 60, or 90 days as the states open. They're panicked. They're afraid that if they don't have it, that there's going to be a hit to their credit rating agency. But think of what they're doing. Most of them are paying interest rates north of 15% on their credit cards. They're running their balances way high as they keep adding the rent on 1, 2, 3 months out. And therefore, their credit score is going down because their percent of balances on their credit cards are going up. So this is a real concerning trend. It's a real opportunity, I think, for our industry, the National Association of Realtors, the Institute, to work with the GSEs. We really need to accelerate the expectations and guidance on how the rent that's been through a forbearance program is expected to be paid, whether there's interest to be accrued on it, because this, with tenants putting this on their credit cards, is a real concerning trend. And I just don't know if anybody else has got any other views on it. I would love to hear more about it. I only found out because of this one client that saw it pick up, and the April rent was kind of a head scratcher and concerned about it as well.
Thank you, Casey. Okay, here we go. So first question, who is the Red Shoe MVP of the week? I think
the MVP Red Shoe of the week. Wow.
You are Mr. Red Shoes, but I think it's more of not, the week should be extended out quite farther than that.
Yeah, I'll
Yeah.
give you a couple on the earnings front. I'll give Clorox. So Clorox could have screwed us all. They could have redirected product to consumers that would pay a higher margin of their product, but instead they gave a lot of product free to hospitals and nursing homes. They directed the accelerated manufacture of products and wipe to first responders, hospitals. They didn't change their margin. It was a lower margin for them. And they did what I call greatest generation like behavior. So in the earnings, there's several companies that I would single out. Clorox would be one of them. In terms of execution, I would say on the retail front, someone like a Weight Watchers, what they figured out and how quickly they were able to pivot to digital from face to face and really power forward with their company. In terms of industrial, I would say, you look at a Prologis or the company that I'm on the board of directors with, Monmouth. So how about a company that collects 98% of its rent in February, March, and April? How about a company that continues to close on every deal, not retrading on it? How about a company that for every small tenant that needed rent forbearance that was tied to a small business, they gave to them? Prologis and Monmouth, the symbol's MNR or Monmouth, MREIC. Go look at those earnings and look at how those industrial REITs performed and executed. They performed well and with compassion in how to tighten the belt. They didn't screw people. They didn't screw margins. So I would say, look at a Clorox, look at a Weight Watchers, look at a public REITs. And on our side, I would say CCIMs. They've stayed open for business. They've been huge resources to their customers. We've done a ton at no charge or no cost with a huge hit to our businesses and our balance sheets. But to the outside world, the CCIM Institute never closed, looked incredibly relevant. And I would say among our commercial real estate industries, I'd put CCIM right up there with IREM on the property management front. They've done an incredible job as well. So I'd give CCIM and IREM MVP awards for professionals in commercial real estate.
Thank you, Casey. Next.
Did I suck up well enough?
Oh, you did awesome. Given the value adjustment notation, how fast do you see the appraisal industry adjusting assumptions in the CRE valuation?
Yeah, I would tell you, sometimes they burn me in effigy at the Appraisal Institute. I'm a scarred multi-generation MAI. I give them grief a lot of time, but I do have to tell you, they have a relatively new CEO, Jim Amarin, who's a very well-versed appraiser, also a good former Marine. So he knows how to execute. He knows how the valuation arena works. They've really stepped forward. They've held really good webinars and education to help appraisers understand that they can't just guess here. They've got to support their market condition adjustments. And if they don't know, it's okay to say they don't know. Maybe to turn down the assignment, or where to look for proxies that are where you could have more forward-looking market conditions adjustments. So for example, in industrial, the comps aren't all going to be sitting there anymore in CoStar. You're going to have to do more work. You're going to have to engage and talk with more brokers. You're going to have to look at what the REITs are doing in closing. Life companies, you're going to wear out more shoe leather. You're going to wear out more red shoes. So the appraisal industry, the commercial side, is really stepping up to that. On the residential side, they really haven't seen a lot of adverse impact, although there's a leading indicator that they were slow to pick up on, but Lawrence Yun has picked up on it and is bringing it out now. The company Redfin has done a good job. It's look at listings data. Listings are collapsing, and they're collapsing for the same reason as refi mortgage applications. Homeowners are opting to stay in place. They're opting to use loan forbearance. And when they are doing that and they're in a forbearance program, they can't refi. It's difficult to resell the home. So we're taking homes off the inventory. The home builders are operating in very bipolar actions. Pulte came out as the first public home builder, and they said, great results. We had one of our best quarters ever, but we think it's time to pull out the 2009, 2010 playbook. They said, we're going to quit buying land. We're not going to honor our lot takedown agreements like we did. We're going to get very defensive. D.R. Horton came out and said, they're crazy. We have strong traffic. We had 40% increase in sales. We understand that buyer traffic now. It's young millennials, professional millennials leaving the city, coming out, trying to buy an affordable home. So we're seeing very different bipolar type of kind of results there. So I don't know if that helps.
That was great. We have 1 minute left. I know we started a little bit late, but we have some really good questions. Can I ask you for 5 more minutes?
You bet.
Okay, thank you.
I'm a 3-part economist. And one part is I'm 1 part David Allen Co. And that means I'll hang around just as long as you'll let me.
Okay, you can hang out all day. Here's a good one. With all the bad economic news, why is the stock market up and doing so well?
I was wondering, I was hoping nobody would ask that because I've been asking myself that for the past 3 or 4 hours. And I think the best answer I've heard in trying to look at some of the good analysts and read some of the good analysts I follow is the stock market is more forward looking than backward. A lot of this data that we're getting is rear view mirror. We knew that the February and March data was barbecue sauce. It didn't reflect what was coming at us in April and May. The stock market is saying we're seeing things change. We think the supply chain is moving. We think the states really are going to open up. We feel more confident we're going to have a vaccine, or we're going to see better testing results, and we're more confident that we can open states and we can get our economy back on track. I think that's the message the stock market is sending, is they're looking forward. They're more confident that the reopening is going to work and we're not going to have to shut the economy down again. That's the only thing I can look at. And maybe the other side is the shock of Warren Buffett last weekend woke them all up and taught them how to do some real financial and stock analysis again. And they did like what I did and went back and was reading a lot of earnings and said, holy bleep, there's a lot of companies that I would invest in that are doing great, starting with Pepsi and going all the way down to some REITs. So maybe it's that they're forward looking and they're finding there's a lot of companies doing pretty well, that they've been able to, through cutting stock buybacks, through just like the tariffs, they tightened up their supply chain, they've tightened up expenses. They're basically functioning pretty well. That's my guess.
I guess it all depends on who you're listening to as well.
That's true. And what time of night?
Yeah. Here we go. With all the tracking, how do we protect from bad actors and misuse of data, whether government or private or foreign? I mean, that sounds kind of scary.
It is, and that's why, everything I've shared with you and the metrics and the data, these are decades established resources and companies, whether, for example, it's a TREP. People forget I was at the New York Fed and I went to TREP and said, how do we restart CMBS and what data do we what data do we need? TREP's been there from the beginning. They understand this stuff. They know what to do. They don't fluff around their data. They tell us what's hidden and why don't overinterpret something good or bad, one way or the other. A Real Capital Analytics, Jim Costello and the Real Capitalitics team and the Real Page team, these are real pros that deal with the data. They verify it 2 ways to Sunday. They break it down by MSA, by property type. You look at the NFIB, the National Federation of Independent Businesses, you're looking at decades of data and methodology in the way they track. It's highly protected and embedded. I wouldn't want to be gambling right now with new data sources and new entities that I've never used before. The real-time indicators, that goes back to the 80s. It's never failed. It's never missed. The TSA PreCheck is a new one, but it's so granular and transparent. What I would say is, who are you doing business with? Where's that data coming from? Where's the transparency in the numbers and the methodology? And then we all have got to be guarded. We've learned from Zoom, we're going to see a record spike in identity theft and nefarious behavior on data and attaching into things, and we're going to have all kinds of data breaches. I just got a notice the other day from a really highly regarded environmental monitoring resource for real estate, and they somehow got hacked, and it was in a basically a merger and a private equity type deal. There was also some money that came in from a foreign entity. So I'd say, like everything, common sense, know who you're doing business with, understand where the data comes from, understand and make sure there's transparency. If you don't have those things, I wouldn't be touching them. And this is where the value of your CCI membership comes through. This is why you have a bulletin board. This is why you have members that you can reach out to and say, and instructors, hey, I need help in this area. Where's the right place so I don't misguide a client? This is a time where we are going to get, and we are getting, incredible value out of our membership dues. I told Eddie Blanton and Greg Fine that my forecast is you will see more CCIMs as a percentage renew their dues at the end of this year because of the value proposition they brought to the table. You look at what they've set up on the website, you look at the Insight series, look at the papers that we've been putting together, whether it's, you know, adaptive reuse, retail evolution, logistics infrastructure. They've been ahead of it. They've been on it. They're all over it. They're engaged with the governors associations, the mayor associations. Look at what the NAR and the CCIM Institute and the NAR affiliates were able to do in 2 weeks on 1031 exchanges, which is 1/3 of all transactions. So I think, you know, don't forget your CCIM Institute. We're there. Your colleagues are, we're the best in the industry. We're the most knowledgeable. Reach out and ask them if you're uncertain about a source or a data piece.
Thank you, Casey. I think that's all the time we have for questions today. I've got about 30 more in the queue, so I think people might want us to do this again, if that's okay with you. Hint, hint.
I'm there for our CCIM colleagues. I'm now one of you rather than just your economist, so I'm very, very humbled by that. And I would just tell you your leadership, you know, you go back over the past couple of years, you start with Dave Wilson and Barbara Crane with what happened with Xceligent and Site to Do Business, how they dealt with that and stood it up. You look at, you know, your leadership and Greg Fine and Eddie Blanton and the whole board of governance and directors team, what they've done through this crisis, the communications team, what they've done to help us with Zoom and everything else. I have to say, I've really never thought over my 35, 40-year career that I could even imagine our industry and our industry group stepping up like this. And I think IREM's done it. I think CCIM's done it. I think NAR's doing it. The Appraisal Institute's done it like they've never done it for valuation. Our commercial real estate industry group as a collective group has really stepped up here. And we all ought to be very proud of that. We really had the right leaders at the right place at the right time this time.
Well, thank you, Casey, for your time. And we're going to give some recognition to our sponsors. And I just wanted to reiterate our mission statement at the CCIM Institute. The mission of CCIM Institute is to elevate our members to the highest levels of success in the commercial real estate profession, to shape the commercial real estate industry by being the most influential, innovative, and internationally recognized organization. So we're going to roll our sponsors from all the different chapters. Each one of you on the call, if you're not in Region 2, there's probably a local chapter in your area. And once you become a member, you can join and get our education and the networking. And I think that, you know, of all the webinars that we all get hit up with watching every single day or not watching, you can't spend your time better than listening to Casey and information from the Institute. It's the top of the top, and everything else I think comes down from us. So thank you again, and we look forward to doing this again with you. We'll try to address your questions at a later date, and we will.
Who put that cowboy picture up there?
I know. This was fun.
That was the Red Shoe Economist when he was a cowboy.
I like that one. We need just a picture of the red shoes for everybody. So we know where the
Thank
red
you all. Be safe.
Thank you. So please share the YouTube link with your colleagues and your clients. And thank you again. Have a fabulous day.